So we're back with part 2 of our discussion on premium finance, and we're going to specifically talk about premium finance for estate planning specifically. So just a general overview on estate planning. Right now, and we're filming this in January of 2024, right now there is a $13.61 million exemption from federal estate taxes. If you're married, you and your spouse each get that $13 million exemption. And what that means is you can have a net worth of up to $13.6 million or $27.2 if you're married, filing jointly and all that. You can have up to that much left over when you pass away without having to pay any taxes. But the second that you cross over that threshold, you're going to owe taxes to the federal government. Dan, what would you say the tax on that first dollar over the $27.2 million for a married person would be? I mean, it's pretty high.
Yeah, I think, Matt, I mean, and we're like, just to be clear, is that we're talking about estate tax now, not income tax or any of those type of things, but 40, 50% above and beyond that. I mean, so, and that's the hard part is that, you know, one thing we know for sure is that these rules are going to change.
Absolutely, they are going to change.
You know, so you know, it's a great right now, and a lot of people feel like I'm covered.
Yeah, 27.2
But what happens in a couple of years, Matt? Tell them what happens in a couple of years.
Right. So in a couple of years, at the end of 2025, so basically 2 years exactly, just a little less than that, the estate tax exemption does something called a sunset. And all that means is it's going to revert back to the pre-Tax Cuts and Jobs Act levels.
Before they changed it.
Right. So they changed it for the Tax Cuts and Jobs Act. And it's going to sunset. It's going to revert back to the pre-figures, which are nowhere near 13.6 and 27.2 million.
Right.
It's $5 million indexed for inflation. So it'll be 5 and change. And there's a whole lot more people out there that have an estate tax or a net worth rather over 5 million, 5 and 10 million versus 13.6 and 27.2.
Yeah. And
yet the tax rates are still the same on that first dollar over, let's just say in 2026, the $5 million. And Dan said, 40 to 50%. I think at the federal level, it starts around 40%. And then there's a lot of states that have individual state estate taxes. And so you're hit with really both of those, depending on what state you live in. And so if you got an estate that's worth $15, $20 million, right now, you don't have an estate tax problem, more than likely, if you're married. But in 2026, you would.
Yeah.
And you would owe, if you have a $10 million estate and you're single, you're basically going to owe $2.5 million plus in estate taxes.
That's correct.
So a lot of people decide to use life insurance to help pay for estate taxes. Dan, what do you see as the benefit just of life insurance in general for the paying of estate taxes?
I think life insurance in general, the reason why people do it is the fact that if they don't do anything, whatever the tax bill is, they're paying it with assets that are in their estate, which could mean, they have to sell properties, they have to sell investments and other things. So a lot of people, for convenience purposes, say, okay, if I think my tax is going to be $5, $10, $20 million, I know I can buy an insurance policy, and they call it, pennies on the dollar. So maybe they're paying 25 cents rather than $1 for taxes. So the main reason why people use insurance is because they pay a discounted price toward that future, issue.
Absolutely. Just a quick story. So I grew up in Illinois.
Okay.
Right in the middle of Illinois, and actually
I'm from
Illinois. And so you know this well. Most of the people around me where I grew up were farmers.
Yeah.
And they had lots of some of the best farmland in the Midwest.
Right.
And if you guys know anything about landowners and farmers specifically, high net worths.
Yeah.
Because that land is worth so much money.
Right.
And yet, in terms of a liquid net worth,
right,
not much from a liquidity standpoint.
Right.
Most of those individuals, their net worth was all in the land and the equipment. And so we saw growing up, time and time again, someone passes away, there's a big estate tax bill that's due because that land is included in their estate, and you would see fire sales on properties, specifically on farmland. And a lot of those farming families, I mean, they would do whatever they could to keep that land in the family. And sometimes they can't, just because there's not enough liquidity, there's not enough liquid dollars to pay the estate taxes.
And they got to do it within 9 months.
Exactly.
I mean, so they don't have a long time period
exactly.
for it to happen.
You try to sell a $10 million piece of land, and everyone knows that you're selling it because you have an estate tax bill, you're not going to get very many buyers inside that first 9 months. It's going to be at the very end when you start slashing the price because you have to, and you're not going to get what the land is actually worth for. And so we saw a ton of those farming community members. They're very well versed in the life insurance game because that's how they keep their land in their families.
Yes.
Using life insurance.
Yep. And so that's really important. I mean, the cost is cheaper and for them to do that. So, I mean, what it really does, Matt, is it gives them choices, right? So they're not forced to do things that they don't want to do.
That's exactly right.
Yeah.
So we're talking today about financing. And we just talked about how life insurance can help with estate planning, and it often does. And if you're working with an estate planner that's not mentioning life insurance, it might be time to get a new estate planner.
It could be.
But how does financing a policy and using other people's money, kind of like we talked about in our last discussion, how does that fit into using life insurance for estate planning?
Well, when I do financing, the nice thing is that, we have to figure out first and foremost is if they don't do financing, what's it ultimately going to cost them to do it? It's going to be discounted for, what we're trying to accomplish. But then also, if we buy a guaranteed policy, they're going to be paying that premium for 50 years, maybe 40 years.
You're talking about a guaranteed life insurance policy.
Like a guaranteed life insurance policy. And yes, it's guaranteed. And whenever I hear the word guaranteed, that means it's going to be expensive.
Right.
Because, risk is free, guarantees are not. And the point is that if I have to pay a premium for 40 years, what a bank will do in a finance and what we do, Matt, is the fact that we'll take that cumulative cost of that policy and then have the bank pay it over a shorter period of time, let's say 10 years. So if I have 40 years of expensive payments, now I create 10 years, that's going to be a lot. And most people won't do that.
Right.
Because the issue with estate planning is whatever the premium is really what I'm gifting to keep that policy out of my estate to pay for the tax. So if I just went from 40 years to 10 years, now that number is going to be high. So if I have a bank come in and do it, the neat thing is that the interest payment to the lender is what is deemed the gift. So I can buy a lot. So I'm leveraging my gifting now so I can buy the appropriate amount of insurance at a discount. And that's really helpful because a lot of people don't understand that. And that's really the purpose of doing that. But then buying the appropriate amount because no one really knows how much, their estate's going to be worth. But what we do then is when we structure the policy is we have it increase. So the death benefit is going to be increasing every year.
Grows over time.
So it helps try to offset as much as we can their growth of their estate.
Let's explain the gifting a little bit more because I think that would be beneficial to our audience. As you mentioned, most people don't understand how the gifting works because it can be complicated. But I'll give the general overview and then why don't you fill in the details.
Okay.
So every single year, there's an amount that I, Matt Decker, can gift without eating into my lifetime gift exemption.
The $13 million.
Which is the $13 million that sunsets at the end of 2025 back to $5 million. So I can give a certain amount every single year without using up that exemption amount. What is that amount that I can give?
Roughly around $18,000.
Around $18,000.
Yep.
And me and my wife, we can both give that $18,000. So
That's
if
correct.
I have, and we can give it to, like if I have 3 kids, which I do, my wife and I can each give $18,000 to each of our 3 kids.
Right.
And we can do that without eating into our total 13.6 as of today. Actually, it would be 27.2 because we're married. We can gift that amount without using up our lifetime gift exclusion.
Right.
And so when you talk about the idea of, paying for a guaranteed policy out of pocket, that whole premium is considered a gift.
That's correct.
And if you have a large estate, you're going to have a lot of kids in order to not eat away at your gift exclusion, because those are large premium type policies.
Right.
But you made a distinction about the financing being different in that the premium is not the gift in a financed policy.
Right.
The amount of the gift is the interest that you pay.
That's correct. So let me explain that. So if I have, based on your example, if I have 5 beneficiaries, 5 kids, me and my wife can pay $18,000 each. That's roughly about $180,000 of gifting. So think per year. So think about if my estate is worth $20 million, and I can give away $180,000 a year.
Yeah, your guaranteed policy is probably going to cost like $400,000 a year.
Yeah, not only that, but like, what am I really doing by giving away $180,000 away? And when I have $20 million, and if I just earn, 1% on that, that's $200,000. I'm not really protecting what I have, right? So when someone says to me, yeah, I have $200,000, I can buy a policy for $200,000 and maybe buy a small death benefit, right, that I'm going to pay forever. But when I do the financing, think of it this way, that if you say I can do $200,000 in gifting, I'm going to get a lender to probably put 5 times as much money of that gift amount into a policy so I can buy a fairly nice policy. To give you an example, I have a 65-year-old couple right now that did that type of strategy, and that $200,000 gift bought them about a $10 million policy.
Wow.
So that's, instead of doing because they were just giving it to their kids, and their kids are doctors. So they're like, my kids don't really need the money.
Right.
So all they're trying to do is lower their estate, but they're not doing a very efficient job because of the fact that they have so much.
Yeah.
I mean, so
you
it's
can
not
only give
changed.
so much.
Right. That's right. So the point is that, so those are some of the things that we kind of work backwards into figuring out a solution that allows them to be, able to protect their, tax liability, I guess, so to say.
So by leveraging the policy with other people's money, what we're also doing at the same time is we're leveraging the impact of their annual gift exclusion.
Right. So I call that almost like a leverage gift.
Yep.
Yeah.
Love it.
Yeah. And other people in the gifting world would say a leverage gift is if I say, Matt, give me, a gift because I have a matching person that's going to match my gift. They call that a leverage gift, right? I mean, we call it like a leverage gift because we're going to have the gift maker, the bank, pay 5 times as much money.
So we're leveraging the impact of our annual gift exclusion by borrowing the money, and we're basically getting a 5-to-1 leveraging of our annual gift is what it sounds like. But let's talk about why this is actually really important right now, today, and for the next year and 10 months, because the way that the estate tax works is, well, let's just give an example. Dan, if I were to use up my $27 million exclusion today, but the law changes at the end of 2025, beginning of 2026, what happens to me? I already gave away more than what the law is going to allow for. How am I impacted?
So I think that's a super good point, is the fact that you gave away 27. Now the state exemption is 10 million.
Right.
If you didn't give away more than 10 million, you just got your exemption reduced by whatever the number is, right? So if I gave away 5, now I only have 5 more to go.
Right.
Now, for me and my wife.
Yep.
Where if I did the 13 prior, it's stated by law that they're not able to go back and say, hey, you gave away too much, we're going to pull that back in. So, I mean, that's where the hard part about this is we're talking about a lot of money, right? And you can't do planning to say, I'm just going to give everything away so then I don't have any money, just because I want to make sure this exclusion is filled.
Right.
So, I mean, so there's a fine line there, because what's interesting in this whole estate planning is that estate planning is a voluntary tax, man. I mean, you don't have to pay it, could have three beneficiaries. You can have your family, you can have a charity, or you can have the government. Your choice. You can pick 2 out of 3.
Yep.
And a lot of people think like, I got to do this, but we can give away other assets and use this policy as what my kids are going to get. Oh, by the way, tax-free.
Right.
Versus an IRA that's fully taxable to them. And if I have to pay estate tax and income tax, that's not going to be very good, right? I mean, so it's all this process of figuring everything out, because the hard part I have with this strategy, particularly in financing, is a lot of our clients came from nothing.
Yep.
Now they've made this money and they're thinking in their mind, do I need to really buy this? I mean, how much do I have to give my kids?
Right.
Because
they didn't get anything.
Yeah. Am I going to ruin them?
Right.
Because they don't understand money. I mean, so those are the things that people struggle with when they're saying, I mean, they understand that they can buy insurance at a discount, but they're saying like, how much am I giving my kid without ruining them? And I mean, I had to work. So that's why you see the people like Warren Buffett, Bill Gates, all those guys are giving their money to a charity. Because guess what? If their kid is the chairman of the board of their charity that's worth billions, they're going to have enough influence, I think, to be okay.
I think so.
Yeah.
So let's talk about how that might work. When we're financing a policy for estate planning, we can't just own the policy outright.
Right.
In order to do this right, we'd have to set up an irrevocable trust. And
Which means you have no control.
Right.
That's the main thing.
Right.
If you control anything, it's in your estate.
That's exactly right. And that's why, giving away $27 million today
sounds great.
Sounds great just to fill your exemption. But when you're doing that, you're giving it to an entity that's no longer you.
Yeah.
Which means you don't really have easy access to it. Is that always true? Are there ways that you can have access to it?
Yeah, there's strategies that you got to make sure you have the right estate planning attorney that knows and understands, like spousal limited access trust. What that means is that the trust is set up and there is ways to derive income from that trust, but you can't do it personally.
Right.
You have to have your trustee do that. And a lot of people do that because if they have these trusts and they have these policies, they have all this money in this trust and they start taking money out of it, then one of the ways to do that is to, have a balance of what's owed to that trust. So when they pass away, the assets that are still in their estate, we have to pay the trust back so we can take those out of their estate.
Further reducing the value of the estate.
We got to just make sure there's enough assets in the estate to cover what the balance is. Because if there's not, then you got problems.
I love how you say paying estate tax is voluntary.
Yeah.
It's a voluntary program. Yeah. But if you're just kind of walking through life, head down, crushing it, making a great living, maybe you've got a $40 million real estate portfolio and you're not focused on this, if you do nothing, it no longer becomes voluntary.
Right. No,
it becomes mandatory.
It's mandatory, but the fact is that we could get the real estate away. Not necessarily today. It can be in the future, but we can get a deduction for doing stuff that we do, and then what the insurance does is become a replacement for assets that we're strategically gifting to reduce income tax and estate tax. I mean, so it takes a lot. I mean, it gets complicated sometimes, but it's fun planning, right? But really, doing nothing is your biggest risk.
Yep.
Because then you have no choices.
That's absolutely right.
Yeah.
Well, estate planning is already complicated.
Yeah.
It changes all the time. Case in point, the exemption being more than cut in half. It's a 75% reduction or so, more than that, in just less than 2 years. And so if you're considering any type of estate plan, I would highly encourage you, make sure you're dealing with someone that really knows what they're doing, that knows these laws inside and out. If they're not talking about things like spousal lifetime access trusts, bypass trusts, if they're not talking about life insurance and the impact that can have, or giving to charity, then, you should reach out to someone who really knows this space and can help you put a plan together that you're happy with.
And I think the important thing is that, Matt, like we love working with the attorneys and CPAs that understand us, because we're not attorneys, we're not CPAs, we don't, we're not professing, but having a team that is knowledgeable about these areas that we can strategically put the best program in place for the client, I think is really important.
Yep.
Yeah.
If you have questions about estate planning, you can head to our website, leveragewm.com. You can see at the top there, book a meeting or contact us. You can reach us there. Dan's website is perpetualwm.com. You can reach out to either one of us. We'd love to help you if estate planning is something that you feel like you need today or maybe in 2 years. Until next time, take care.